Welcome to the AI Chat Podcast. I'm your host, Jaden Schaefer. Every day, I cover cutting-edge AI news and talk with the leaders behind it, breaking down what it means for your life and business. Anthropic is in talks to raise $50 billion at a $900 billion valuation, and this would push it past OpenAI for the first time ever in its valuation. And I think in some of the private markets where, employees or other people are trading shares on the secondaries market, Anthropic is already ahead, and technically their revenue is already ahead, although OpenAI says that that's a technicality due to some one-time deals. Regardless, this would be the first time, if it actually is executed, that Anthropic raises above what OpenAI was able to raise. In addition, AWS launched OpenAI's frontier models, Codex, and their managed agents on Bedrock today. This is also the same day that Microsoft's exclusivity deal expired, so there's some drama going on with Microsoft and OpenAI. And actually, I think this is going to get, a lot of people are going to be using OpenAI that weren't before because of a couple things happening here. Also, we have tech layoffs. We've just cleared 40,000 people laid off in April. We have year-to-date layoffs of over 96,000, all primarily being attributed to AI. Whether AI is the official cause or not, I think isn't as clear. This is what everyone's kind of pointing towards, and there's a couple different reasons and a couple things that I think people should be doing if you were just laid off or if you're at a company that's doing these types of layoffs. There's a couple things that I will highlight that I think are actionable items. Okay, in addition to all of that, on the April 29th earnings night, Alphabet shares rose 6%, Meta fell more than 6%, Microsoft and Amazon both fell 3%. We're going to get into why, and there's some pretty wild reasons. First things first, let's talk about the AWS and OpenAI deal. What actually happened is that OpenAI's GPT 5.5 and also GPT 5.4, both of them are alive on Bedrock, in addition to their Codex platform and some of their other interesting things they have with their agent harness. All of this is going to be put onto Bedrock. Now, the reason why this is kind of big news, because it's like, okay, great, it's like on another cloud platform. I think a lot of people don't understand that Microsoft Azure had an exclusive deal where OpenAI could only be on Microsoft Azure because Microsoft put $10 billion in and kicked off this whole, wild AI feeding frenzy when ChatGPT first launched. And so OpenAI has been stuck over there. I actually think a lot of the problems that OpenAI has faced, including the fact that Anthropic kind of soared past it with a lot of people using Anthropic and developers in particular and enterprises in particular using Anthropic and Anthropic kind of beating them in revenue. I think a lot of this is the fact that OpenAI was stuck on a platform that was just not the default for a lot of enterprises. I, for one, know that, my startup, AIBox, we use AWS for everything. We can't, of course, we could just get an API, and so it's not the end of the world. We have OpenAI models on our platform, but we're built into AWS, and we couldn't switch to Azure if we wanted to without having to pay a big bill and doing a whole bunch of extra work. And so it just wasn't a big enough draw for us. And if a lot of the tools inside of OpenAI were exclusively over there, it just makes it so less people will use it. Moving it over to and creating this partnership with AWS, I think we're going to see a massive jump in usage. And it's actually interesting because I was recently talking to some people over at AWS who manage our account for AIBox, some of our sales reps and whatnot. And they specifically have different deals and discounts that they were offering me to switch our usage off of our API onto just like they're like getting the Anthropic credits directly through them. And I think they'll now do the same thing with OpenAI. So it's interesting for Amazon. I think this is a great deal. For AWS, I think this is a great deal because they're kind of working this, and I'm sure they'll have, they give you like $100,000 in free tokens, but then they'll go and maybe slightly mark it up, or maybe they get a discount as a bulk rate from Anthropic or OpenAI. There's a bunch of deals that they can swing there. So it's good for startups, but it's also probably really good for their business model, and it keeps people embedded into their system. And I think they really want it to be, coming through them. It makes them feel like a bigger customer to OpenAI and Anthropic. The reason why this is a big news deal is because the timing on it was pretty insane. The launch occurred one day after Microsoft and OpenAI's exclusivity deal officially ended. So the second it ended, they immediately were launched on AWS. There was even kind of this wild interview from Ben Thompson at Stratchbury where he basically did like a joint interview with Sam Altman and AWS CEO Matt Garman about the announcement. In that interview, Garman said enterprise customers want OpenAI on the infrastructure that they already trust, which is basically, AWS alluding to the fact that, their customers don't trust Azure. I wouldn't go so far as to say that, but I do think it's a funny jab from a competitor over at Microsoft. Okay, let's talk about the tech layoffs that have happened so far in April. We closed out with about 40,000 tech layoffs in this single month, according to Business Today's tally that they've done. The year-to-date tech layoffs are now over 96,000. There's a whole bunch of companies that have rolled them out: Oracle, Meta, Microsoft, Amazon, Disney, Snap. According to Yahoo Tech, all of them have laid people off. Oracle laid off at least 10,000 employees on April 1st. That's about 6% of their 162,000 workforce. There's some reports as well that the total could go up to 30,000 before they do some restructuring, and it's all kind of completed. Oracle leadership tied the cuts to AI data center investments. I mean, we know Oracle right now, they have their I think they have like a $40 billion SoftBank joint venture that they announced earlier this year, and they have to spend so much money on that. And so, yeah, it seems like they're just trying to cut it from the workforce. Meta cut 8,000 jobs. That's about 10% of their workforce. They also killed 6,000 open job listings on their website. So if you kind of put those two together, the people they would have hired and the people that they did fire, they're at, 14,000 job cuts. Meta's company-wide memo specifically, Zuckerberg said that they needed to ensure efficiency as they were scaling and spending in other areas of the business, aka Meta is also spending very heavily on infrastructure for their AI models. And then Microsoft offered a buyout to about 7% of its US workers. And I think this is the first time in Microsoft's history that they've done a buyout. So it's different than kind of like severance. They're actually buying people out of their career entirely if they've been at the company long enough. So very, very interesting. Microsoft's chief people officer, Janelle Gale, wrote a memo and basically cited the need to drive efficiencies and offset the company's other investments. Everyone keeps saying, look, we're doing this because we got to offset our other investments. What are the other investments? In all of their earnings calls, it is spend for AI compute. Snapchat cut 16% of its workforce, which is about 1,000 employees. They also closed 300 open positions. Their CEO, Evan Spiegel, cited AI-driven efficiencies in his letter to the staff on why they were doing this. So there is a lot happening right now with these layoffs. What I will just say on all of this is if you're someone that's been recently laid off or your company is in the process of doing layoffs, I just think no matter what happens, we're at kind of a painful point in the market, if I'm being honest, where it feels like a lot of the capital expenditures that these big companies are planning, they're going into compute, they're going into AI. Some of these things, though, when you're talking about building a data center, this is something that you spend money on, and that data center's got value for many, many years into the future. So it feels like a lot of the costs are being front loaded today for benefits that the companies will get in the future. But in order to pay for those costs, they're coming from a painful place of the workforce, and they're getting these new efficiencies from AI that makes it possible. But it's interesting because the company, less than focusing on just like pure, well, we have all this extra capability, why don't we just give everyone more access to AI, and then hire more people and do more and make more. It feels like they're kind of like, look, we have this extra efficiency, so we're going to keep going in our current trajectory. We're going to cut people and continue growing, and then put that money into something else. So it is a painful point in the market. I think, to be honest, there's going to be a lot of positive things that come out of this. There's going to be a lot of entrepreneurship. There's going to be a lot of interesting businesses and ideas that will happen as people kind of go out on their own. And I think that you'll have a lot of the talent that was previously at Microsoft and Meta trickle down to other smaller software companies, other smaller businesses, more niche areas. And I think that's not necessarily a bad thing. So I know a lot of people probably won't like that opinion because typically when you move from like a Meta or a Google to something less well known, your salary isn't as high. I think overall, though, we're going to solve more problems as a global economy, and globally, it will probably have a net positive economic impact, and a lot of these companies will grow. So I don't know. Maybe that sounds like a crazy take on it, but that's what I believe. And I also believe that the people that are investing heavily in learning and understanding the AI tools that go along with their expertise, learning how to use Claude Cowork for your specific job function, those are the people that are the most hireable for their next role. And they're also the people that if you are using all of the AI efficiencies inside of your current role, the most likely to stick around and get promoted inside of your organization. So really becoming an AI advocate and someone that's pushing the efficiency inside of your organization is what's going to help you personally and is going to be what helps your company. Okay, let's talk about what's going on with CapEx because we had a lot of earnings reports from some of the big companies. Last night was earnings night for Alphabet, Meta, Microsoft, and Amazon, kind of the big ones. They all hit at the same time. and they collectively are expecting to spend about $600 billion on AI capex this year. So a wild number. The stock of Google, or Alphabet, right? It went up 6% in after-hours trading, and Google is the only company that I think is really convincing Wall Street that the extra money they're spending is bringing in more revenue. So Google has done that where a lot of these other companies I'll talk about weren't unable to. Google Cloud, their quarterly revenue was $20 billion. That's up 63% year over year. Cloud operating income rose $6.6 billion from $2.2 billion in the prior year period, which is phenomenal. Sundar Pichai, the CEO, said on the call, quote, "We are compute constrained in the near term." And he also said that the cloud revenue would have been higher if Google could meet demand. Basically, there's so much demand, Google just couldn't service it all because they didn't have enough compute, and they're like, oh, we'd have more money if we had more compute. So basically that's kind of the perfect setup for them saying, and look, we're going to spend a bunch of money on compute, and if we have this, we'll be able to make more money. Like, there's more demand. So Google is a company that is, I think they have that order correct. Google Cloud backlog is about $460 billion. And their CFO, Anat Ashkenazi, raised the 2026 CapEx guidance to $180 billion to $190 billion, somewhere in that range, which is up from the previous range of $175 to $185 billion. So they have moved their CapEx guidance up. They're going to be spending more, but they're obviously, very clearly saying if we had more compute, we'd be making more money. They said also that the 2027 CapEx will be, quote, a significant increase from what they're doing this year. So if this year they're doing 180 to 190 billion, next year is going to be a significant increase. And I think they're also just kind of setting everyone's expectations. Their spending is going to continue. They're able to make a lot of money from this. Okay, so how did the other big tech players fare in all of these earnings reports? Meta's stock fell more than 6% in after-hours trading, even though they had a 33% revenue beat. Their Q1 revenue was $56.3 billion. The net income was $26.7 billion for the quarter. This was boosted by an $8 billion tax benefit. Their 2026 CapEx guidance raised it from $125 billion to $145 billion. Before this, it was at $115 to $135. So, on the lower end, they're pushing it up $10 billion. On the higher end, it's up $10 billion as well. So they kind of moved their CapEx, expectations up $10 billion. Mark Zuckerberg said that the spending is going to strengthen the ad business by making recommendations more relevant and improving targeting for, Instagram, WhatsApp, and Facebook. I mean, this is kind of this is definitely an interesting spot, because Zuckerberg is like, look, if we spend all this money on AI and all our CapEx, like, we'll be able to optimize our ad business and we'll be able to make more relevant, ads, and then technically we'll be able to make more money. And that's his kind of justification for this. Whereas Google obviously is, saying, look, they have a cloud platform that people are paying them to run models off of. And so if they build more compute, they can host more, they can service more customers on their cloud platform. Meta doesn't really have that same pitch. Their pitch is just like, oh, look, we can serve better ads. But it kind of begs the question, like, how much more optimized can their ads get? How much more money would that make if they were, slightly, some percentage more optimized? It doesn't feel like Wall Street really believes that line from Zuckerberg. And so in an article on Fortune, there was a pretty good framing on this where they said only Google convinced investors that spending more is paying off. It doesn't feel like Meta being like, hey, look, we're going to spend another $10 billion. And Wall Street's like, okay, you guys have plenty of money. And and I don't know if it's going to make that big of an impact. Okay. What happened to Microsoft? Their stock fell 3%, although I don't think it's just for their earnings. It's kind of interesting, too, because a lot of these companies are posting earnings. They're like, look, we beat expectations, and sometimes it's by a lot. And yet, investors are like, well, you beat expectations, but they're like worried about what's going on in the future and where the ball's going in the future. So for Microsoft, their stock fell 3%. Their Q3 earnings per share was $4.27. That was adjusted versus the $4.06 expectation, right? So, I mean, they're like 21 cents above the expectation earnings per share, which should be great. The revenue was $82.89 billion. I mean, they're, getting close to $83 billion there. Azure and their other cloud service revenue grew 40% in constant currency, which is ahead of the 38%, which Wall Street was kind of guessing. So, I mean, it's 2 points higher than the expectation, which was great. And, on the one hand, you'd be like, okay, amazing. Their AI annualized revenue hit 37 billion. It's up 123 year over year. But they also bumped their CapEx guidance to 190 billion. That's up 61% year over year, including a $25 billion impact from some higher component pricing. So they're like, look, a lot of the components we need, they've increased in price. We're gonna have to spend an extra $25 billion on that. When they bumped their CapEx up, Wall Street did not like that. And I think there's a couple of reasons. We talked about one of them, but when they had OpenAI move off of being exclusively on Azure, I think people are kind of worried about that. And it came right before the earnings report. Their CapEx came in at 31 billion in Q3, which was below the $34 billion analyst consensus. So they actually spent a little bit less than people were expecting in Q3. Their gross margin compressed to 67%. That's the narrowest it's been since 2022, by the way. As I think it's because there's a bunch of depreciation costs from data center buildouts. All of that's getting accelerated right now. What's really interesting to me is, on the one hand, I think a lot of people are saying, look, Microsoft kind of lost this exclusive deal with OpenAI. And Microsoft is, by the way, talking quite publicly about the fact that they're like, look, we still have, we don't have to pay royalties on having OpenAI on our platform. And because of that, we don't have to pay royalties till 2032. Satya Nadella, the CEO, literally said that they're going to, quote, exploit not having to pay royalties on that. So I think they're trying to say, look, like, that deal broke up, but we have some other like good terms that were in that deal. And it's going to, be beneficial for us. So they're trying to kind of like, tell people not to worry about it. What's interesting, though, is that Microsoft's share fell on all of this news. And at the same time, Amazon did their earnings and their stock also fell 3%, which is interesting because you would think Amazon's the one benefiting from the fact that OpenAI is now moving over to be on AWS as well. Like, that should be a big boom for them. It doesn't feel like that's, really priced into anything or making big impact. And of course, the stock price has a lot more to do probably with the CapEx plans of Amazon than just kind of these headliner like, oh, yay, OpenAI is going to AWS. Speaking of having a bunch of different models on one platform, if you are already paying for ChatGPT or Claude or Gemini or Grok or 11 Labs for audio or any other AI tools, I would love for you to check out my startup, which is AIbox.ai. We have over 80 different AI models in one place, everything from all of the top, AI labs. We have 11 Labs for audio. We have tons of cool audio, tons of cool video platforms as well. We've added video in there, so you can actually use OpenAI's Sora model. You can use Google Veo. It's $8.99 a month, and you get access to over 80 different models, all types of models, and you use them all in the same chat. I love it because, I use Claude a lot because it has awesome tone for everything, so I'll have it help me write things, but then it doesn't generate images, and so I'll say, okay, now use OpenAI's image generator, and then I could say, okay, now use Google Veo to create a video with this kind of concept, and I'll, then be like, okay, I need like an audio overview for this. Give me it with 11 Labs. All of that is in one chat on one platform. It is incredibly useful and also saves you a ton of money not having to have subscriptions to every single platform. If you want to check it out, it is AIbox.ai. It's linked in the description. I hope this saves you a ton of money and is incredibly useful for you. We even have it 20% off if you get the annual plan. You get a 20% discount. So really, this is a no-brainer. It should help you a ton. Links in the description. Okay, let's talk about what's going on with Anthropic. This is kind of the wildest story coming out today. Bloomberg, CNBC, TechCrunch, all of them are writing about this. And basically what's happening is that Anthropic has a $50 billion round they're putting together at a valuation, which I think there's like the headline is 900 billion, but apparently it's kind of a range between 850 billion and 900 billion. The reason why that's important is because OpenAI's last round closed at 852 billion. So, I think they definitely want to get over that 850 billion mark. They want to put themselves as valued at more than OpenAI. And also, to be fair, this was in February. So we are, it seems like, it might seem like only 2 months ago, but that's basically a lifetime ago in February, right? So 852 billion for OpenAI. Anthropic, their last round that they did, which was also in February, was 380 billion. Guys, Anthropic moved from 380 billion to potentially 900 billion in 2 months. That is insane. And I think a lot of people are saying, well, this is super overhyped. The market currently is supporting it though, which is what's wild. And I think this is being driven by multiple preemptive offers. So Anthropic, I'm sure Anthropic's happy to go talk to everyone, but Anthropic isn't necessarily going out and begging everyone for money. People are coming to Anthropic begging to put money in. I've seen tons of news articles about this. People offering they're like, hey, I'll sell my mansion, and I'm only going to do it for Anthropic shares. So if anyone's got Anthropic shares, let me know. There's a bunch of people saying stuff like that. Anthropic hasn't accepted any of these offers yet from people that are trying to put the money in. The board is reportedly going to make a definitive call on this round in their final valuation in May. So it's not going to be happening immediately, but it looks like at the board meeting in May, they're going to decide if they want to pick up that $50 billion or not. The revenue trajectory for Anthropic is really wild, and this is why they're able to get so much money, and even OpenAI is kind of struggling in this. At the end of 2024, Anthropic had $1 billion in annualized revenue. At the end of 2025, they were at $9 billion in annualized revenue. At the end of February 2026, they were at $14 billion in annualized revenue. March, $19 billion. April, $30 billion. And reports that right now they're at close to $40 billion. It's like $10 billion every month this year that it feels like we're just going up since March, which is absolutely wild. That equates to about 1,400% year-over-year growth. So if anyone's wondering why are people offering to get in to Anthropic at a $900 billion valuation, their growth rate is absolutely insane right now. They're hitting enterprise and they're hitting developers who just are spending heavily compared to OpenAI, who has close to 1 billion weekly active users, but most of them are free and a lot of them are just paying $20 a month. So if you're Anthropic and you're charging people $1,000 a month, it's a lot easier to make much higher multiples. So on April 28th, the Wall Street Journal reported that OpenAI missed their internal goal of reaching 1 billion weekly active users for ChatGPT by the end of 2025. I guess that was what they were trying to get to. The same Wall Street Journal report said that OpenAI missed multiple monthly revenue targets in Q1 2026 after Anthropic gained a lot of traction. So Anthropic was surging, people were putting money over there, and OpenAI was getting less. I actually know a lot of people that canceled their OpenAI subscriptions. Maybe they'll bring it back with some of their new features. The CFO over at OpenAI, Sarah Fryer, she reportedly warned people inside the company that if the revenue growth doesn't accelerate, the company is going to face a lot of difficult funding situations in its future, especially for all of their compute commitments, right? So they have all of these big deals with Oracle and with SoftBank where they're spending there's a $500 billion deal or whatever for Stargate. And it's going to be hard for them to fund all of that if they can't grow their revenue. So it seems like OpenAI and Anthropic are in completely different places. OpenAI's board directly reportedly scrutinized the company's recent data center deals. They also questioned Sam Altman's effort to secure even more computing power, even though the revenue is basically going down and Sam Altman's out there trying to get tons more computing power. SoftBank Group, their shares dropped about 10% in Asia after this Wall Street Journal report came out, so I think a lot of people actually believed it. Oracle, which has a $300 billion 5-year compute partnership with OpenAI, they dropped 4%. Their stock dropped 4% as well on the news. OpenAI publicly has kind of went and pushed back on this. Leadership over there have said that this, that all the leaders are, quote, totally aligned on computing investments. So no, Sam Altman and Sarah Fryer, they're totally besties. They totally agree on all of this. And of course, they kind of have to come out there because all of their partners' share prices are tanking due to this. Only time will tell if OpenAI is going to be able to catch up to Anthropic as far as revenue goes. I would definitely say don't count them out. They got a lot of tricks to play and things to pull. And I mean, as you can see, they could cut an entire product line like Sora video editor or video generator. They save a ton of money there. So they could really refocus and try to get their revenue up. Okay, that's it for the show today. Guys, I am trying to crack 200 reviews on Apple. If you are listening on Apple and you haven't left a review yet, it would be insanely helpful to me and for the show, just for the algorithm. If you could leave a review over on Apple, drop some stars. It helps the show out a ton. Thank you so much, and I'll catch you guys all in the next episode.